If I could show you how to save hundreds of thousands or even millions of dollars in interest expense and pay off your house extraordinarily quickly, would it be worth 20 minutes of your time? I bet it would. Good morning. My name is Doug Waldman. I'm the HomeSelect Savant at Geneva Financial. Geneva is a full-service lender. A lot of accolades, as you can see below here. We've come through this crisis, financial crisis, extraordinarily healthy. I'm thrilled to represent Geneva as I do. They do everything. So we offer FHA, VA, conventional. I call it strawberry, chocolate, or vanilla, right? We offer all the same stuff everyone else does, but we have a portfolio division. We do in-home, fix and flip, rehab, bridge loans, construction loans, reverse mortgages, commercial loans. But the game changer is the HomeSelect product. This is velocity banking. It is an interest cost savings loan designed to pay principal down before interest expense, unlike a normal 30-year amortizing loan where you're paying predominantly interest first and principal later. This is for people who have more money than month. You may not qualify. This is for people who are conservative in their finances, good credit, reserves, equity, down payment, whether it's a purchase or a refinance. But if you manage to qualify, game changer for you and creating familial wealth and legacy wealth for your family. Why give millions of dollars or hundreds of thousands of dollars in interest expense to a bank if you don't have to, especially on a non-performing asset like your primary residence? Let's dig in. So this loan is not new. It's been around since 2005. It came out with at CMG Financial. We at Geneva are the only correspondent bank with this product, so we're very proud of that fact. It's an all-in-one loan, and it's designed to lower your costs and to maximize the benefits of homeownership. It makes you your own banker. This is most likely one of the last loans or the last mortgage you'll ever do on the house you're currently in. What is it? It's a 30-year open-ended line of credit. It's a home equity line of credit, a HELOC. Open-ended, but it is also tied to a sweep checking, FDIC-insured checking account. So it has two distinct pillars to this product. And the benefit is an absolutely amazingly dynamic tool for those who understand how money works. This is how the wealthy get wealthier. Let's go further. You look at a normal 30-year amortizing loan, and you'll see on this graph that up until about year 15, you're almost paying equal amounts of principal and interest. Prior to that, you're paying almost all interest. The 30-year amortizing loan is a very old product. It was designed in the 30s to help people buy homes after the Great Depression. After the Great Depression, people didn't have money to put down on houses. Right? The old school way was very short loans or no loan, and you had to pay cash. People didn't have the cash anymore. They got wiped out. So we had to come up to do something to help people get moving again. It certainly did, but now it's been so ingrained in the United States culture that we just assume this is the only game in town, and it is not. And it is front-loaded with profits for the bank. The banks are certainly entitled to the profit, but why would you pay extra profit if you don't have to? Again, for those who qualify. So we're going to do an analysis between the HomeSelect product and a conventional 30-year loan. So on a 30-year loan, let's say the house is $825,000 in value, $680,000 financed. Okay? 30-year amortizing loan, you're going to pay typically nearly $1 million in interest expense, or 146% of the amount you borrowed. So that $680,000 loan, you're going to pay back almost $1 million extra in interest. Do you have to? You probably don't. Let's go further. So 30-year amortizing loans are okay vehicles. I mean, there are times when that's the product I would put a client in, but it's not for everybody. First-time home buyers, sure, they don't have established savings habits. They have passive income, might have low positive cash flow. These are the types of folks that probably fit better into a 30-year amortizing loan. But for those who are qualified, those who have shown that they're able to handle their finances, why? Because it is it takes decades to pay off, right? You're paying a loan off in 30 years. Our average client on the HomeSelect pays off in 7 to 12. It's inefficient. All the profits are front-loaded for the banks. Banks love it because the average client is in a loan for about 5 to 7 years before they refinance. And set the clock all over. Set the clock all over. Front-load all that money, the profit. Front-load all the profit. Have you ever noticed that when you go to refinance a house or even a car for that matter, and you're a couple years in, you're like, I owe what? Like, I haven't even dimpled my principal, really? Really? That's exactly why. And they're just expensive. You're going to pay, while this slide says $50 to $80 per 100 borrowed, we've already shown that it can be significantly higher than that. And they're very rigid. If you need 50 grand to, let's say, rehab your kitchen, if you've got a 30-year amortizing loan, you're going to go to me and say, hey, Doug, I need 50 grand. I'm going to say, the only options I have are refinance your 30-year loan and make a cash-out refinance, or go to a HELOC and get a second loan on top of that you then have to pay back on top. This loan allows you, as long as you have the line of credit available and you've paid down on principal, write a check for whatever you want. The balance just slightly goes up. This loan is so flat. I call it the Swiss Army knife of loans. If you have a crisis, you get laid off. If you've got availability on your line of credit, don't make a payment for a month. No derogatory effects are listed on your credit. It still shows paid as agreed. Your balance just climbs. You want to take a year off and take a sabbatical from work and go write a book or have a midlife crisis? You can do that. It is extraordinarily flexible. If you only need to make an interest-only payment for a little while and you need to make maybe a half a payment of normal, you can do that. It is the most flexible loan available in the United States. Period, hands down. So the HomeSelect product is pretty simple. You put money in to drive down principal. So you deposit money into your checking account. At midnight, we're gonna start applying that towards your principal, and we're going to start sheltering you from interest expense. You can pull money out whenever you need. It's a 30-year line of credit, and you can use it for refinances or purchases. There's no balloon payments. There's no prepayment penalties. 30-year draw, so you have access to the line of credit for 30 years. 10 years is the full amount, and then it starts reducing at 1/240th per month. And at 30 years, you get to zero. The only time people refinance this loan is to either increase the line, because if their house has gone up in value, they can get a bigger line of credit. They can go to 80 or even 90%. Or because they want to stretch the clock out longer and just to have that 10 years of full draw available. People who are heading into retirement. This is easily a tool that could replace a reverse mortgage for many and give you access to the funds that are available in the house. Use your house as a tool, as you should, and they just set the clock back and start over and gives you 30 years. So if you're going in your 60s, this line would be available until your 90s, and full draw if you're in your 60s into your mid 70s, or depending on your age, right? So a lot of opportunities here. It can use for purchase refinances, owner-occupied loans, non-owner occupied, even investment properties. Again, this is for glued together borrowers. 700 FICO score. We can go up to 90% with mortgage insurance. It's a small hit up front, or 80% no mortgage insurance, 75% on investment properties, up to 43% debt to income ratio, depending on reserves and credit. We can do a 5-year fix, a 3-year fix. Right now, everyone is doing the 1-month adjustable because we know rates are going to drop. And why not just keep letting this loan automatically ride down the rates? One of the things you're going to realize by the end of this presentation is that rate is not the end-all, be-all to a mortgage anyways. The 3 components to what a loan really costs you are how long you have the money, how much you borrow, and the interest rate. Because 2 of those things are pretty static, right? How much you borrow and 30 years are things you really can't control. If you're buying a house, you need X number of dollars. And 30-year amortizing loan is, you've probably been told, is the only way to go. That means that you have to beat up your lender about the interest rate. By the end of this, you're going to understand that interest rate is not all that. Okay? So this is tied to the CMT, which is the constant maturity treasury. And that is simply it's an interpolated number that aggregates all the auction data for the 4, 13, and 26-week treasury bills, the 2, 3, 5, and 10-year treasury notes, and even the 30-year bond market, puts that all together and comes up with a number. This loan is simply that number. So the CMT is the index, and then there's going to be a margin on top of that. That becomes your interest rate. As the CMT drops, your interest rate will float right down with it. Pretty standardized tool that's used for a lot of adjustable rate loans, and it's a pretty stable index. And it's actually, in my experience just recently, it started dropping faster than even the Fed rate. The Fed, has not touched their rate, the prime, but we're seeing our rate already starting to move a little bit. And I have a suspicion that will be beneficial for my clients over the next several years at least. So let's look at this. First, again, it's a first position lien 30-year HELOC. You have available credit, you have your principal. It's tied to the checking account. So again, there's three pillars to this. There's your family's budget, there's the loan itself, the line of credit, and then there's the checking account. It's three separate pillars that all get put together to create the most powerful mortgage out there. And this is an FDIC insured checking account. It's the same as any other checking account you're going to get. 24/7 ATM, check writing ability, online banking, account security, customer service available. The game changer here is this, the zero balance sweep checking account. So this checking account is devised that every night at midnight, it's going to move whatever money is in your checking account to the line side. Now, we should all agree that you really don't have money in the bank. You've got ones and zeros. It's all digital, right? You don't have cash in the bank. You've got ones and zeros in the bank. So all it's doing is taking these two parallel pillars and taking money, let's say you have $10,000 here, it moves it over to here and lowers your balance by $10,000 at midnight. Then it calculates the interest expense for the day. When you do that day in, day out, week after week, month after month, you'll see that it's extraordinarily powerful and really shelters you from a lot of interest expense that you just don't need to pay, again, if you qualify. So let's look at our money. Our money is spent periodically, right? We have food, on the weekly side, you have food, entertainment, dining out. If you're in my house, Amazon apparently is a weekly expense. The trucks are in front of my house every day. You got your monthly expenses, your home utilities, cell phone bills, cable, mortgage, HOA, subscriptions, right? You got quarterly insurance, medical, whatever. Property taxes and travel expenses could be a semi-annual, and then your income taxes. Well, so let's say you have a $10,000 or $100,000 line, and you've already paid your bills for the month, or the bills for the first, and then on the first you got let's say you deposit $10,000, a commission check, whatever it is. The number's really immaterial. So at midnight, it's going to move over. It's going to push down your balance to $90,000, right? So now we're going to calculate interest on the $90,000, not on the $100,000. You're sheltering $10,000 from being charged interest. Now let's say on the 5th, you have to write a car payment for $500. Your balance simply goes from $90,000 to $90,500. You're still sheltering all that other money for 10 days or for 5 days, you sheltered $10,000, and now you're sheltering $9,500 still from being charged interest. Now let's say on the 15th you have to make 3 credit card payments for another $1,500. Balance just climbs up to $92,000, but you've still been sheltering money that entire time. That's how this works. That's how this is so powerful. Income taxes. You might be setting aside, if you're self-employed, you might be setting aside money on the quarterly, and you're just leaving it in a checking account doing nothing. Instead, put it into this checking account, pay down your principal. The money's still there. It's on the line of credit. You just write the check, and the balance comes back up. But for 90 days, you haven't paid interest on that money. Starting to see how this works? So it's pretty simple. We just simply take your nightly balance, as I stated. We're going to multiply it by whatever the interest rate is for that month. We divide by 365. That's your monthly. Well, that's your daily interest, and then you do it by the number of days in the month, and you can see that we aggregate it here. On the 21st of the next month is when you make your payment, just the interest. But again, it's just going to come straight out of the line if you have the availability, because you're depositing all your money into this account anyways. The money's still there. It's on the line side until you retire the debt. Once you retire your house, then all your deposits will start piling up in your checking aside, and you're obviously going to want to then get into other investment vehicles that help you accumulate more wealth. But in the meantime, your primary residence is a non-performing asset. You don't want to pay interest on depreciating assets, cars, boats, right? You don't want to finance those if you can help it, because not only are you paying interest, but add insult and injury, the value is going down. The next is your primary residence, because that is surely going up in value, but who's paying it? You are. You're paying it. So it's a non-performing asset because you're having to pay for it. So you want to get that paid to where you have no interest as quickly as possible, right? So let's look at the scenario. We have somebody who's depositing $195 a month, $195 annual into their checking account. Let's say they're spending 75% on that on expenses, whatever it may be. They have roughly 50 grand left over, 25% left over at the end of the month or at the end of the year. This is all annual numbers. We'll turn this into monthly numbers here shortly. Again, it's an $825,000 valued house. We're financing $680,000. We're going to compare a 7.25 conventional rate to the HomeSelect. You'll notice the difference in rates here. 7.25 on the 30-year fix. My rates on the HomeSelect is 8.8. So I'm spotting 1.6% to the traditional mortgage, and I'm still going to destroy it. Destroy it. Let's go further. Let's look what happens. So using those metrics and putting them into the algorithm, which you'll get access to, the HomeSelect simulator, you put the information in. In this particular situation, this person is going to pay off, or this household is going to pay off their loan in 9.6 years. Under 10 years versus 30, they're going to pay interest of $328,000 versus $989,000. See how I mentioned that the interest rate really is immaterial? We're going to save roughly $250,000 in interest expense for this particular client. They're going to spend $1 million in total expense versus 1.669. Just powerful, extraordinarily powerful. What else would you do to have to save $600,000 in 10 years? It's a lot, right? And now, in the normal loan, you'd be paying off $1,800 in principal per month. Our loan, we're paying off $6,000 a month. The amount we're paying off as a percentage is 10% versus 3.3. We're paying 48% in interest over the course of the loan versus 145%. We're saving 100% of the loan amount in interest expense. And here's the kicker. Remember I said I was going to spot the 30-year amortizing loan, 1.6%? But look at our comparison effective APR. Ours is 2.8 versus 7.25, all things being equal. So if there's equal points on each, look at the differential. Powerful. So again, how does this work? You simply have you make a deposit, you spend your spendings each month, whatever you haven't left builds up in equity. You do it again. You do it again. It keeps on repeating. So it looks like this, right? So you make your deposit every month. You spent, let's say they had $4,000 left over at the end of the month, so now you build up $4,000 equity. Do it again. Do it again. The money's still there. It's just available on the line. It's just ones and zeros. You can take your money out whenever you need for whatever you want, but put it to work when you're not utilizing it. Because let's face it, you know your bank's not paying you anything for your deposits. Nothing. They're not paying you anything. Right? So here's how it really looks in a graph. So the blue is loan principal, green is equity. So, you get this loan, you have the first 10 years is full draw, and then you have 1/240th reduction till you get to zero. But let's look how the average person utilizes this loan, right? So they start making their deposits, and boom, all of a sudden a kid goes to college. Now look how much equity they've built up already. You simply write a check for the college. You don't have to ask for anything. You don't have to apply for a loan. Write a check. You can't continue to pay down, pay down, pay down. At year 10, they basically, on this particular scenario, they got to zero. They've paid off their loan. They still have a full line of credit that's slowly reducing, but that's a lot of available credit. $680,000 available, and they don't owe a house payment anymore. They just owe interest and insurance and taxes on that house. They don't have to make a house payment anymore. They're done in 10 years, right? Now, let's say they have paid off, and in a couple of years, I'd like to invest in buy an investment property. Stroke a check for the down payment, finance the rest of the house, or maybe you're making an investment into something else. You simply stroke a check. Take a dream vacation. The balance goes up a little bit. Continue to work it off, pay it off, right? You have medical expense, write a check, pay it off. It's a safety net, but you're not making a house payment after month 10 or whenever you pay it off. Again, the average person pays this off in 7 to 12 years. You stop living for your house and you let your house and the financing work around your life. It's a big difference. Because again, as we've talked about, your lender on a 30-year loan does not care that you got laid off. Make your payment. We don't care that you had a triple bypass. Make your payment. We don't care that you want to go take time off and do something other than what you've been doing. Make your payment. With this, if you've got all this equity, you could literally stop making payments on this loan. The balance would slowly climb, but nothing detrimental happens. You're now using your house as a tool. You're now your own banker, and you don't need to ask permission to do anything. You don't need to apply to do anything. You just do it. You're an adult. Handle yourself. So again, go to the HomeSelect challenge. Go to gohomeselect.com. You can go to the simulator there. Make sure you're putting in good data, meaning the net number is on your income is the net number. That's what hits your checking account. The mortgage stuff is pretty self-explanatory. You can reach out to me if you have any questions. And then the final page on the expenses, at the bottom there's a toggle there. You want to tell the algorithm how much money you have left over at the end of the month. If you're maxing out your 401k, and let's say your lender or your employer only covers half of that, maybe just go to the point where your employer reaches out or matches, and then beyond that, move the money into this and play with the numbers, see what happens. Again, talk to your financial planner, talk to your CPA, but for qualified borrowers, there's no stronger tool. All my contact information is here. I'm a dedicated workaholic. Feel free to reach out. I will definitely get back to you in short order. Thanks for watching. I look forward to helping you shelter interest expense and get your house paid off as quickly as possible.